or somewhere in between. I want you to arrive here fully present. My name is Tony and you are in the CPI and interest flow session. Now before we start, I'd like to present to you that promo code TStream bonus 100% on your first deposit. It's going to be a quite insightful live stream for you, because if you think about the theme flow, the word flow is very important. It's not just about price moving up or down. Flowing is occurring beneath the surface. I look at it as the movement of capital, the shift in risk appetite, the quiet signal from central banks that eventually becomes a roar. So let's look at what's happening around the world.
Singing sweet melodies, pure and true.
One moment, guys.
Saying, this is my message to you.
Right, guys.
Oh, don't worry about a thing.
Kindly,
every little thing gonna be alright.
Golden breeze touch my face at dawn. Hear the rhythm of peace carry on. Them little birds singing love so strong, saying hold on baby, won't be long. Don't try, don't you fear the fight. Every little thing gonna be alright.
What's happening to momentum, to volatility, and I'm going to explain all that in a while. I'm going to try and explain that, be as eloquent as possible. It's very important to know where you guys are tuning in from. We have an open Q&A, so while we go through the live stream, feel free to write your questions. I'll be checking them out, of course. So what do we have today? So why did I name this session the way I did? Why did I name this session the way I did? Well, it's pretty obvious that the session has a lot to do with today's core data, CPI. We have core CPI. If you look through the streams, we've gone over and over, looking at interest rates, inflation, and how that has an impact on current market dynamics. Okay guys, so I want to see who is inside, who is tuning in. The music is high, I can't hear it. Kelvin, thank you very much. I'll reduce that. Hope you can hear now. Okay, we are set. We are set. Okay, the technicals are fine. Today I want to tap into major central banks, right? I'm going to have a quick discussion on that and why I think it's very important to also understand that. So you could copy all the websites that I use. Most of them are free. So we're not here to scream about buys and sells. The economic calendar is quite obvious. We have CPI in 5 minutes. 5 minutes and 15 seconds. Okay. So again, we're not gambling on headlines. We're just trying to understand. It's very important to understand why you're even here, by the way. That's a whole different topic. We're here to become students of the market. Even professionals are learning every day. We're here to observe the pulse of the global economy through two of its most vital signs, and that is inflation and the health of the American worker today, particularly, right? I'll be also checking the BLC website. So yesterday, GDP for GBP and unemployment claims. Now, if you've been following, it's habitual. You have to understand that looking at the market from a fundamental perspective is one of the most important skill sets that you'll have. Technicals alone are good, indicators work, but you need to lubricate all that. Now, the complexity that of the fundamentals regarding CPI gives us a massive opportunity, all right, for those, of course, who know how to listen. So we're going to try to turn the noise around into a narrative that we can understand, right? Sort of building a map, and of course we'll trade later on. Now, looking at the global timings, all right, let's go through the index. We have 43 on the Bitcoin alt season. We do have a lot happening with Bitcoin, particularly. Why I mention that is we're looking at capital flow. Bitcoin sitting at 67,000, right? Okay, time-wise, all right, what is happening here? What is happening here? All right. Glad you can see me, yeah. Wonderful. So time-wise, it's 8:27 New York. Remember the sweet spots, the right timing, entry points. You have to also have that in mind. Now, before a single line is drawn out on a chart, right? Before we even think about any kind of entries, on a chart, right? We need to go to the source. We don't trade on rumors. We don't trade on someone else's interpretation. We trade on data. And the source for what we care about today is right here on this website, the BLC, US Bureau of Labor Statistics, right? You go to data tools, we'll have some inflation. I'll talk about the inflation calculator and try to break it down in simple, understandable terminologies, all right? Alright guys, so inflation basics, CPI, we know that that is consumer price index. It simply measures changes in the price of fixed basket of goods and services that urban consumers pay directly, right? We're looking at prices of anything. Go to the groceries, understand what's going on over there, and try to see, have we grown ever since time X? Has the economy sort of is it decelerating? While PCE, on the other hand, is personal consumer consumption expenditure price index, right? So that is slightly different. It measures price changes for a wider range of goods, right, and services consumed by households, including those purchased by third parties. So before we understand CPI core month to month and year to year, these numbers can come differently and they can have different impacts on the market depending on the instrument that you'll be trading. Now, if you want to compare CPI and PCE, why many get it wrong is CPI is consumer based, but PCE covers a broader spending that is accounts for substitution, and that is actually what the Fed likes. That is exactly what the Fed likes. So go down to the website and look for latest publications. Okay, latest publications. This page will have today's 13th. All right, so it will be updated once we have the data coming in. Okay, and once we have that, we'll jump right into it. So if look at it like this, if beef prices rise, right, CPI says inflation is high, but PCE notices consumers switching to chicken, right? So it's a more accurate reflection of spending behavior, right? What is the heartbeat? I think this particular indicator is one of those heartbeats for fundamental analysis regarding the US dollar. So this government agency is the official scorekeeper, right, of the American economy. They're the ones who call up thousands of businesses. You know, they track millions of prices. They understand what's happening at the micro level. So micros are very important. So let's walk through exactly where this data lives. because I want you to be able to do this by yourself. So go to the website. Please ask questions if you are tuning in. I'd like to please, what is happening to signals? I'm not receiving them. What is happening to signals? All right. The music is high. Fine. Guys, please ask questions that are connected to today's topic, right? If you have anything particular, please elaborate and explicitly state what you need. Okay, so let's move to the data tools, news releases. News releases, right? Inflation, consumer price index. There you go, right? Check it out, write that, and we'll have this. This data actually shows food, energy, and all items. Yeah, from the home page you could navigate through latest news releases, right? Publications, latest publications. So the data should be out now. Spending, all right, there we go. 0.2%, 2.4%, 0.3%. Now we have the data. Let's try and break it down using the official website. Okay, economic releases, major economic latest releases, consumer price index. And what you want to do, you could check out the PDF right there, right? This is later on when you have time. For January, and we'll go over that when we have the weekend streams, all right? But now I want to draw your attention to the consumer price index summary. So today's 13th, you see it's 8:30 a.m. data is released. Okay, now what is happening here, right? When you look at what's going on, from this data, if you quickly have been practicing this, you'll be able to understand these numbers that you see on Forex Factory, where you have 0.3 core price CPI is what we're going to focus on. So the consumer price for all ABN increased by 0.2% on seasonally adjusted basis for January. 0.2% and all right, that is one. The index for shelter rose by 0.2%, food index by 0.2%. So you could see this. You could see this seasonally adjusted changes for CPI. And ever since 2025, July, right? You could look at this in time frames of 6 months. Look at what's happening with food from 0.1 to 0.4, all the way up until the end of January, which is 2.9. Now, what does that tell you, right? When you go to data tools and you want to check out the inflation calculator. Now, I want to explain what I just said using a calculator. I'm going to give you this example, right? Let's say in year 2000, you had $100 in your pocket. Okay, $100 in your pocket, and what would it buy? If it would buy X kilograms of meat for $100, right? What would it buy then, right? We put 2,000 in the first box, which we check out $100. And now we calculate its value in 2026. So there you have it. It has almost twofolded, right? It's increased by $92. So meaning the same amount of food would cost almost twice the amount in 2026. We're looking at an interval of 16 years. So look at that. To have the same purchasing power today, right, as $100 had in, say, the year 2000, you would now need over $192. So that is not a small number. That is roughly 92% of erosion of the US dollar's purchasing power over a period of, say, close to 2 decades, right? Now, why does this matter for a trader sitting in front of a 1-minute chart particularly? In the signals, I usually instruct from 2 to 3 minute expiration times. Why do I do all this? Well, because this is a silent pressure the Federal Reserve is fighting against. Every time we get a hot CPI print, for example, the forecast was 0.3%, right? Month to month. Every time we get something hot like that, what does that say? It just adds another brick to this wall, right? So it tells us what the Fed is thinking. Your work is not done, right? The erosion continues, it continues. So this shows us that the dollar continues to erode. Now, when you understand this long-term trend, you stop seeing CPI print as just a 15-minute scalp opportunity. Because I'm sure if I checked out what's happening with the US with gold, did we have any spike? We didn't have anything. Well, you could just say like a 20 peep, right? All right, USD card. Yeah, we got some spikes here and there, but it's not like before. That's why some of my videos clearly explain that you cannot trade the same strategies you used in 2024, 2025. Every year is very dynamic. You have to see things a little different. Okay. Now it helps you when understand why the higher for longer narrative has so much weight. Right, so this is the foundation, right? This particular example gives you an understanding of how I break down my analysis. I highly recommend that you visit this PDF when you have time and absorb the data. Now, let's look at the language of the central bank. Check out, there are many sites, but this is the closest that I found, fxstreet.com. So there are quite many conversations happening right now between the world's most powerful central banks. On this particular page, we see Federal Reserve, we see the European Bank standing at 2%. We also see the next meeting and the last changed, right? It doesn't make headlines. They don't even flush anything, right? But they move more money than any single data print ever could. So the language of the interest rates is very important. Every major currency in the world you trade is sort of tethered to one of these numbers here. And every single one of them tells a story, not just about where a country stands today, but also about where its economy is heading and how the market actually perceives its future. Okay, do we have any questions yet? Yeah, a few people watching. All right. So the Federal Reserve currently sits at 3.75%, as you can see, right, according to this table. This is the anchor. It's pretty much like the benchmark against which all others are measured. The last move was in let's see, last change. Yes, let's see. Yeah, the last move was in December 10th. Yeah, December 10th. And with inflation still sticky, the message is clear. Higher for longer. The dollar doesn't need a rate hike to be strong, right? It just needs everyone else to stay where they are. So it's like a game. They keep fighting between each other. The European Central Bank currently is at 2%. That is a 175 basis point gap. That gap is not just a number, it's a current capital flow from lower yield to higher yield. it flows from the euro into the dollar every day. So quietly, relentlessly, this is why euro US dollar has structural weight beneath it. So regardless of the intraday noise, this will come handy. If you look at the Bank of England sitting at 3.75%, on paper, they stand equal, but markets know that paper is not reality, right? Go do your research and understand capital flows and actually how the banks operate. Settlements and all these things are very important. Now, why am I giving you all this insight? Before you even press the buy or sell, you need to at least have a hint of the impulse of the market. For example, the UK economy carries different fragilities, right? Different inflation drivers, understand them, write them down. Different political headwinds, what's going on geopolitically now. So while the rate is the same, right? While the rate is the same, the confidence behind is not. Remember, we had Brexit, we had all the hype going on. We saw what happened. So cable, as they call it, becomes a battleground of perception versus reality. Moving forward to the Japanese yen. I want to highlight Japanese yen, which is currently at 0.75%. Japanese yen, the outlier, right? The only major central bank that is still moving toward normalization rather than away from it. That's why many consider it a safe haven. Even if you look at USD JPY, the move carries a lot of divergence. So it's Fed pulsed and Bank of Japan always climbs, right? It creates a tension that plays out in pips, and we can see that if you look at some of these assets. That's why we have some instruments that are slower than others, some measures, we consider them much more stable. And let's look at Bank of Canada. Of course, the others are 0%. Bank of Canada, which is at 2.25%. So we know Canada is resource rich. The housing is very sensitive. It's deeply tied to the southern neighbor. You know who I'm talking about. So 150 point gap against the Fed, and we see oil spiking, and that can overshadow everything. So the risk sentiment can actually mask it. But beneath every USD card candle, that differential is the foundation. The Central Bank of Australia, which is at, as you can see, 3.85%. Now, this is just a summary. You could go check out each individual bank and sort of study the indicators. Try to get what actually is happening. So the Reserve Bank of Australia actually yielding more than the United States on paper. The OC should attract carry. But Australia is also the gateway to China. So I'm just looking at it from a macro perspective. So the barometer global risk appetite, when fear rises, yield takes a backseat and confidence returns. So OC usually leads. We have New Zealand. New Zealand should be somewhere here. Yep, there you go. These are major, we're just looking through. Now, New Zealand, these are mainly the pairs that many people like to trade. That's why I'm highlighting them. So, New Zealand at 2.25%, which is smaller, more volatile, of course, but equally sensitive to the global growth story. So, the gap against dollar is very significant. We could check the performance indicators. I've mentioned that quite a number of times. So, the distance from major liquidity centers is also a factor. We call this the Kiwi, New Zealand. Kiwi moves when no one is watching. If you pay attention and you know how to snipe some of those moves, swings, you can get not just lucky, but you're informed. Now, Switzerland sitting at 0%. We know what's happening with Switzerland. It's a safe haven that charges no rent, 0%. So you look at their inflation calculator from the example that I gave to you. What was the Swiss franc in, say, 10 years ago is pretty much the same. So the inflation hasn't really significantly changed. Maybe pricing has increased, but in times of fear, for example, capital floods, and despite the lack of yield, in times of optimism, we see the flow out just as quickly. And the Swiss franc is the banker. It's very essential, but very uncomfortable to stay in too long. Now, why I'm saying all this is I want to give you an insight, an idea of how I read this data. Here is what the rate table won't tell you. Just this table alone doesn't tell you many things, right? These numbers are not static. They are alive. They breathe with every inflation print, every job report, every sort of whisper from any central bank governor. We can feel what's happening. So today's CPI data doesn't just move the dollar like, you know, you wake up and it has moved. It will shift the entire conversation. It will nudge some expectations from the Fed. We see what's happening with Trump and his insider wrangles with the Fed head. So we want to look for these ripple effects through every moment that we can see. So that's it with central banks. There's a lot, of course, behind it. You want to get more insight, please ask your questions. Central bank rates, it's not just about memorizing numbers, guys. Please don't do that. It's about hearing the conversation between them, right? You have to feel the flow of the market before it appears on your chart. You have to feel that. All right, let's try and decode now some of these numbers. Okay, where did we have that? All right, now looking at the, let us see what we have regarding, okay, we have gold pushing up. Good, very good move there for my scalpers there. All right, guys, we've been to the source, BLC. You could check out the numbers. There's a summary usually. Now, these are hardcore numbers, right, for 2026. Upcoming CPI changes. We'll have technical or not. Right, there's good explanations here. All right, they actually give the time to explain how some of these numbers came. It's mainly econometrics, but you don't need to know all that, right? What we're targeting is just these adjustments. So we want to look at food and compare it. Is it increasing or reducing? And as far as we can see, it has reduced, right? From 0.3 to 0.2. Energy, we had a drop. So we've generally had significant drops, which we can see here, 0.2%. Now you have to start asking yourself some questions like, why have they dropped, right? Is the economy cooling off ever since we had the New Year holidays and so forth? All right, so month to month is sitting at, let's see, month to month is sitting at 0.2%. Right? It's, of course, it's cooler than 0.3%, but yeah, reduced, and we had 2.4% year to year. Great. Now, core CPI, the difference, again, core CPI, month to month, core CPI simply removes some of these other parameters, and it's very good to understand also why it strips out food and energy, right? Unemployment claims came out previously. I think it was 263,000. reduction, right? Non-farm employment rate was 4.3%. Okay. Anyways, nevertheless, we are heading out into the session. So now we need to kind of make sense of all this. Now, on the surface, we have a mixed bag. We have some sticky cores. We have some headlines there. So unpacking inflation has to come prior to any move. Now, because the headline number is just a summary, right? The real story is in the components. And this website, BLS rather, tells us exactly what drove the 0.4% rise or 0.3%. Was it shelter costs? All right, we go to shelter. Was it the cost of electricity? Look at electricity from 0.2 all the way up until 6.3%. Right, and adjusted. Okay, unadjusted, right? So yeah, you need to ask yourself, what is the heavyweight champion of the CPI basket? That is shelter. Remember, shelter is right here. We had 0.2 all the way till 3. So that has rapidly increased, right? And is it slow moving? Is it sticky? So this isn't a one-off. This is a structural pressure that keeps core inflation elevated for months, sometimes even quarters. We see this a lot. And remember, the country is quite big. So we look at energy. Energy jumped to right. Energy. Let's look for energy. Consumer, right. Energy rose 0.3% in January. So that is the volatile part, right? Energy is a headline grabber. But again, the Fed tends to look through energy spikes, right? Expecting them to fade. While food rose by 0.2% over the month, as did the food at home index. So food rising, that gives you a feel of the realities of people on daily lives. How much were noodles, a bag of, what was the logistical expenditure for each of these items and so forth. So the Fed looks at this breakdown, and what do we see? We see that shelter stays stubborn. They see that wage growth, while cooling slightly, it's still fitting into services inflation. So the message to the central bank is very clear. The work is not done, and hence it keeps going on and on. So we're very keen to looking at next timelines for the cuts. On one side, Trump is talking about cuts, while the Fed can't. You just can't make the rate that will have a very big impact, right? It can actually lead to a collapse of currency if you just play around with these numbers. So let's look at another side of the coin, right? The labor market. So for long, the job market has been unshakable. We had some job claims. Job claims. Where was that? We had job claims somewhere. Unemployment rate. Non-farm employment change. Yes, regarding job claims, we've also done a lot of NFP numbers. So what does a rise in jobless claims suggest? It suggests that companies are starting to feel the pinch of high interest rates and very much softening labor data introduces fear. So these are classic examples of stagflation scenarios where the economy slows too much while prices stay high. So that's the worst of all worlds for policymakers. When you have a situation where the economy is slowing down, but we have prices remaining high. You know, teachers are getting this amount of money. The workers on the street are getting the same money, but it kind of feels like the economy is slowing down. So for the market, it creates a tug of war. We start looking into the bond market, where the smartest kids in the room are the referee. We watch the yields also surge. It means that inflation narrative could be winning. So if yields, for example, stall or even pull back, it means the growth scare is taking over. So we'll keep watching these games. I like to call them games, tug of war between central banks, and we look into other institutions and what actually they do. So all this plays a role in decision making. Now, when it comes to building some kind of map, right? Let's look at that, building a map. Before you even do anything, let's see. Before you do anything, before you even switch to a 1 minute or 5 minute or whatever minute your time frame you're scalping, we've understood the data, right? You've understood the data, you've practiced. It's not a one week thing. You have to keep grinding the data understanding. If you miss, say, a couple of months, you pretty much need to get back on track. Now, how do we translate that into actual trades? So we don't trade opinions of people, of things, right? We're not imagining. We trade a map. And I'm going to build one right now for you, live with me, right? And we'll culminate with some trades later on. Right, we got, today was quite insightful. We have 2 minutes left, but we'll keep doing these breakdowns. So I use a very simple colored coded system, right? It keeps my mind very clear and my entries disciplined. I call it red, green, and blue. So red zones are resistance. Many of you do that. Primary red zones today is yesterday's high. This level is where sellers have previously shown strength. Okay, so go to the daily, map that out. Okay, you could just have yesterday's high, right? Yesterday's low. Oh, there we go. All right, we got it. All right. Red zones are resistance areas, so simply resistance areas. Those are primary zones. This level is where sellers previously shown strength. We have potential supply zones right up here. Green zones are support areas. We usually use green for support areas. I particularly. Green zones, I try to use them for support areas. And buyers pretty much step into these zones, and that's why we have these rejections or pullbacks. There's so many names for them. And then blue line is my 50 period exponential moving average. So this blue line here, I use 50 moving average, right? The last 50 candles. Now when we move to a lower time frame, it starts to make sense. It's a trend follower, like it filters out whether we're in a bear or bullish trend cycle for that particular move. So price below tells me momentum is down. It's not a crystal ball, and there are explanations to everything, right? Don't just take it as textbook theory. There are reasons why we say 50 and 30-day ranges or 15-day ranges depending on the instrument. Now this is more of technicals, right? So we have some direction, we have some kind of roadmap of what we're looking for. So I'm primarily now watching gold. Okay. Now you want to also check out whenever you're working with USD, because it is the base currency here. And if you're working with gold, you also want to compare what's happening with the others. And I've mentioned so many times, you could go check out performance indicators on what's it called, bar chart. Yeah, bar chart has a good performance indicator. You could just refresh that. You don't need premium. You could just check out what's happening. Look for currency performance indicators and look for gold. You could also look into what the bonds are doing. All right, so we have the USD dollar USD index. Yeah, we have it at 0.03%. Okay, and you could also check out the index, right? And we will look at correlative strategies with the futures and US Treasury bonds. Those ones also good for getting. Oh, by the way, the VIX has pumped today at 20, so that's a good sign for the start. We still have a long way to go before we get crazy momentum coming in, but these are all indicators. Yeah, so primarily we want to watch what's happening with other currencies. What's going on over there? Are we in some kind of consolidation and so forth? Okay, what's happening here? I need to keep restarting my screen. Yeah. All right. Yeah, and so much more, right? So it's very simple. You mark out your areas, and then when we start to really go down, at least you have some kind of idea of how we're playing around. You could see where, for example, where this part looks very interesting. Why did it reach over here and why did it pull back? It also tested it one more time. As you could see, tested it right there at the high and then pulled back. So weekly, you want to see how the weekly looks like. Right, and so much more. So there are many rules that I use, but rules of engagement, before we take a single trade, we have to lock in the rules, right? Because a setup, a setup is only 20% of the equation, right? The other 80% is how you manage it, which people call psychology, and this is what separates professionals from gamblers. You have an idea, and my approach today is based on one word: patience, right? We are trading aftermath. It's already past 30 minutes, and we'll be sending some signals. However, patience, you see, I've taken the time to understand, to break down the data, to see what's really happening, and it's not 15 minutes, it's already close to 30 minutes. So rule number one, I don't chase any candle, right? I don't chase any candle. We had some opportunities there. As you could see, everything was perfectly aligned. The parabolic SAR, the super trend, and alligators were right. We had that move, but we didn't. So understanding your patience, tolerance, when a price approaches the red candle, the green candle, what are you supposed to do? Are you supposed to wait, and so forth? Yeah, and of course, respect your risk. We have a nice calculator here, and I highly recommend 2% always. 1% for beginners, 2% if you know what you're doing. And then you could, of course, check into this martingale strategy, put in your deposit balance, and it will calculate for you the steps. So you could do all that, and once you are ready to execute, then we can have scenarios for that. So risk is non-negotiable for me. It's the only thing that you can control. Risk is non-negotiable, right? And guys, we are a little bit late today, but do you have any questions I'd like to ask anyone out there? Yeah, so when I enter, I might put 50% of my stake, which is of the 2% or the 1%. And if it moves in my favor, I could take another 25% off the 50% and so forth. So the final 25%, for example, I let it run with a mental stop, right? I highly recommend using stops if you're a newbie, and let it run, guys. Seeing it can catch a bigger structural move. You just manage it as it continues. So no hopium here. We'll do some live executions going forward, and you also want to look at the aftermath. So my 5 key takeaways, we're rushing now, are: be the source, right? Don't listen to people, listen to them, but take what you think is right? Test different strategies. Be the source. I'm giving you the resources. Go to the websites, break down, crunch this data, have Excel sheets, have journals. I have my journal here. This is actually just got done, and I need to renew my journal here. I have everything. I have everything well structured, right? Look past the headlines, structure your anchor, right? Use support levels, whatever you like. And then confirmation is king. Never trade the first candle. Let the market prove its intent over, say, 2 or 4 candles, right? If you ever feel pushed to enter, you are probably getting it wrong somewhere, and you need to reflect. Capital preservation is your only job. Risk 1%, have a session drawdown limit, and know when to walk away. Your mind is your greatest asset. Please protect it. Trade with discipline. Learn from every single session, every single trade. The goal is not to be a better trader tomorrow than you are today. I'm Tony. Thank you for spending this time with me. Thank you for being part of the floor. Join me in my free group. The link is in the description. It's been a very good one. I'll be in my community pushing out some high quality signals. Let's continue the conversation. Until next time, guys, stay safe.